at our members mentoring night. We had a bit of a fun time, bit of a social. We launched a cool new property up in Brisbane, and it was well received. So hopefully everyone is great, awesome, and well. While the old Facebook Live is warming up and people are jumping on, I'll do a few little intros and hellos to the regulars returning, like Alison, always there. Great to have you back again, Alison. Good morning. Great to see you. Welcome back to the regulars. Anyone who is joining us this morning new, and hey, morning, Alexis. Anyone who's joining us for the first time, welcome. Jason Whitten is my name, and we get together every now and then as a bit of a crazy property investing crew and chat in the mornings. We call them Wealth Coffee Chats, around about 8 o'clock each day, and we talk about the property investing journey that we're all on together. I have been investing in property 20 years myself, coaching property investors through our business, Positive Real Estate, over 18 years. And along the way, we've learned a few things. We learned that you should buy well and potentially, if you can, never sell, and your properties will do all right. It's a marathon, not a sprint. It takes some time for your properties to grow in wealth and create the cash flow and the passive income you need. So we get together in the morning, support each other, and make sure that we, keep our eye on the prize. So morning and welcome to Christina, Rodney, Alison. Yes, absolutely. We were talking about that last night, Alison, and reach out to Deanne and Sam, and we'll get that organised. Absolutely. We'd love to get you up for an RE experience. That would be super cool. As an investor in ARIA yourself, it's nice to go and hang out in one of those buildings and get a bit of a feel for it as well. That's for sure. So morning, Elena, Honey, James. Great to see all of you guys on. Hey, today I wanted to have a bit of a chat about depreciation and how does it work. I get these questions all the time, trying to understand the idea of tax deductions and cash flow. So I thought we might sort of do maybe a little bit, maybe a little bit nuts and boltsy today, a little bit nuts and boltsy. Sometimes we talk big picture, sometimes we're talking, opinions, and sometimes we might talk a little bit about the nuts and bolts of this thing that we're doing when it comes to the world of property investing. Good morning, my love. Good morning. How you going? Good to see you. Morning, Facebook user. Sometimes that just flies in like that. Not quite sure what happens, gang, but whoever that is, good morning to you. And Adrian, great to have you on as we go. Thanks, Rodney. Cheers, mate. We tried to do something bit of fun and pretty cool last night. As always, live television, live Zooms, live whatever, in a new setting. Some of the bibs and bobs will tweak, but we really enjoyed it, and glad that you guys had a good time too. Thank you. So listen, I've put some numbers in here of a property that I purchased a couple of years ago down in Melbourne, Collingwood. Now, I just want to show you some of the interesting things going on in the world of property investing. And I want to just, hey, morning, Trina. Good to see you. I just want to have a little look at what and how depreciation, your tax deductions, applies to cash flow, gang. And I just want to sort of talk through this today. And I'm not going to try and dive too deeply into the calculator itself, but I just want to talk about some of the ideas that we need to keep an eye on, or how and when to claim your depreciation, your tax deductions, because for many of us, it's an important part of our cash flow, and we got to keep it rolling. So let me just quickly take you through this investment for me, as we went, for me and my beautiful, lovely wife, Shay, we wanted to get on one of these good opportunities down in Melbourne. And so we purchased, our price point, our budget was pretty good. So we got into the property for $786. And you can see some of the associated costs. And we put a bit of cash into the deal for deposits. One of the things that I want to point out for you guys right here is this down here, which was our interest rate, because you can see that interest rate and you go, whoa, that's pretty chunky. And because for me, my borrowing world, and as for many of you, as you buy more and more properties, the lenders consider you more risky, and they charge you more interest, unfortunately. So we're in the process of reducing that one now. It's a little bit better, 2-3 years later for us. That was in the middle of that APRA weirdness. That was low doc lending and 5.8%. So, however, it doesn't stop. It didn't stop us. It shouldn't stop you when it comes to your property acquisition, your acquisition plan. The cost of money can be rearranged later. Sometimes you've got to pay a little bit more to begin with to claim it back a little bit later on. So, and as we go, this is the thing that I really wanted to for us to concentrate on today, which is depreciation. The ability for you to claim a certain amount of that property expenses in your cash flow, in your tax deductions, which is not a real cash expense. And we're going to talk about this in a minute. A real cash expense is paying the rates. A real cash expense is the body corporate. A real cash expense is the interest. A real cash expense is property management. An expense which is not real cash is depreciation. On paper, it shows that money went out. You lost some dollars. Let's say, for example, the carpet. The carpet might be worth on paper $3,000. $3,000 in 2018. And now in 2019, the carpet's actually worth $2,500. Okay? So what happens is that is a negative $500 loss on paper. And what happens is you get to claim that loss, which is not real cash loss, but it's depreciation, the reduction in the value of your asset or your fixture and fittings as a tax deduction. And I think that's a good thing. It's actually the most efficient tax deduction weapon / thing you can do as a PAYG earner, okay? And I'll show you why in a minute, why that's really important. So for you guys, when you're looking at this, understanding, yes, there are costs. Now, what we do want is we want your costs to be as close as possible, the real cash costs to be covered by the rent, as close as possible. And then we get some tax deductions, which can top our cash flow up by claiming some money. So let's go over to the all-important thing that we want to have a look at, which is our cash flow. So you have a look at this line here, gang, which is the line that you want to be having a bit of a look on. I don't know why that's doing that weirdly today. Let me see if this does any different. Did it yesterday too, but anyway, let's do it like this. That line there is our before tax, our pre-tax cash flow. And so, on paper, right now, the cash flow looks like we've got to put $100 a week into that property. Now, that's not optimal, you might say. Many people can't afford that. That I'm not going to buy the property. However, if you finish there, then you might be cutting your nose off to spite your face because this property might be great. So let's go and have a look at what this looks like. Now, in here, there's $20,000 of depreciation, which is a non-cash loss. Overall, which includes the costs, your total interest, your annual property expenses, et cetera, plus the depreciation, you get a total down here. I'll go back. A total of deductions, which are pretty good. Now, stick with me here when we have a look at this, because this is how it works. We get to claim that stuff back. We, on paper, look a bit average on the property, but then we get to do the thing we need to do, which is get our tax back, which is against this property $11,000. $11,000 minus your -6 equals positive cash flow, $4,681 for the year. Ta-da! So what we do know, if you structure the property properly and you understand how to do this well, a property that might on the surface pre-tax cash flow look unattractive for whatever reasons might be attractive if you structure the cash flow properly and you understand using depreciation. Now, what does that mean for you? For somebody who is PAYG, which is pay as you go in your income, if you're employed by someone and you have to pay taxes weekly, fortnightly, or monthly, you should claim your taxes. You should claim back your depreciation. You should claim back your tax refund as you go. It's called a PAYG variation, a variation, and any decent accountant should be able to do it for you. Now, hear me when I say this. Sometimes they're just lazy and they don't want to do it because it takes a bit of effort, but make them do it. Because the difference, gang, look at this. The difference here for you is $6,000 out of your cash flow for the year, or $4,000 into your cash flow for the year. Which one do you want? Do you want to struggle along all year, coughing up another $100 a week? Or do you want to not struggle at all? Matter of fact, $90 a week is coming back into your pocket, okay? Consistency in cash flow back in your pocket. And where do you put it, gang? Where do you put that cash flow? You guys know where it should go. It goes into your offset account. All right. And it helps pay your home off faster, okay? So I just wanted to sort of touch base on that one today, because I have had a few questions about what is depreciation? What am I losing money? How do I claim money? Now, obviously, if I was to grab the calculator out and I was to change this property to 3% interest for you guys right now, most of you can qualify for maybe a 3 or 3.5% interest rate. That cash flow would be very attractive. Matter of fact, it'd be probably between $7,000 and $8,000 after-tax cash flow, and pretty well pre-tax cash flow neutral. Okay, so not every property behaves or financially performs exactly the same way for each owner. Okay, and so this is where you sitting down with your coach, your PC, and your finance team, your 6-star team, to analyze the property, make sure the cash flow is good for you, makes a lot of sense. So hopefully that was not too deep, not too detailed for this morning, gang, as we go, because understanding if you didn't claim those tax deductions as you went, your accountant was lazy, or, you'll be right, wait till the end of the year, all of these sorts of things. That, ladies and gents, can be the difference between, I'm going to buy another property, this thing's great, it works a treat, or that was a horrible year. I hated it. We couldn't go on a holiday, we couldn't go out to dinner, we couldn't go to the movies because we just, struggled. $100 extra a week was shit. And that's the difference, gang. It's not 9 times out of 10. If you buy a good property in a good spot, and you manage the finances right, you'll have a good experience. Unfortunately, the experience after purchasing sometimes is the thing that that makes people rethink property investing. I've seen that so many times. Anyway, there you go. Quick coffee and chat done. Give us a shout out in the chat if that made sense. If you've got any other things you want me to chat about, maybe some nuts and bolts every now and then, give me some questions, give me some feedback. I'm always happy to take a little bit of guidance, any questions that you might want to know. So hopefully that made sense, gang, as you're going. Oh, that's awesome, Alison. Getting right into it. Love it. Love it. And maybe one day, if you're up for it, give us a shout out. There's lots of opportunities to become a coach in the future too. There you go. Well, that's it, gang. Done and dusted. Yeah. It makes sense to see an accountant. Absolutely. Yep. For sure. Whoever that was, you're dead right. It absolutely makes sense to see a good accountant. So, James, thanks, mate. Same to you. That's it. Done and dusted. Wealth Coffee Chat over and out. 25th of May. Hope you're well. Join me tomorrow on the 26th of May for another Wealth Coffee Chat. All right, gang. Take care. Bye for now.